Steve, one of the things people often ditch when they're when interest rates are going up and they have less money is going to the pub. Has that been showing up in a certain stock you've been tracking's results?
Yes, and no. I mean, it's been showing up in the JD Wetherspoon, but the bit that's been showing up is the inflation-y bit. So Spoon's had some really interesting earnings I've written today, and it was actually yesterday because I was getting ready to do this then. But that stock had a nice little run afterwards. I think I talked about this a couple of weeks ago, and following yesterday's results, stock was up about 13.5%. It's up about 40% over the year, since the start of the year, sorry. It's still down on the 12-month chart, to give just to put things in a little bit of context here. But it reported its earnings for what it calls the first half of 2023. It's the run into the end of January, basically, for them. But revenue came in at 916 million. These are in pounds for once, compared to 807 the previous year. Operating income was 37.4 million versus 1.6 million. Net income was 37.4 versus a loss of 11.5. Earnings per share were a mighty 1p, compared to losing 19.7. And free cash flow came in at 166 million compared to 21 million in the same 6 months the previous year. That's 123 per share in free cash on a stock that was trading at around £6. It might be closer to 6.5, 6.6 now, but that's quite a lot in free cash terms. The reason for that, and this is one where you kind of have to dig into this a little bit, because if you think that company is going to make 123 every 6 months into the future, it's well worth £6.60. It's worth a lot more than £6.60. It's worth probably more than £26.60. But it's not, is the answer, is the long and the short of this. They got 169 million, so slightly more than their total free cash flow, off a one-off thing, which was selling a bunch of interest rate swaps. Interest rate swaps are not particularly fascinating things, but they are things that companies like Spoons use to protect themselves from interest rate fluctuations. If you've got a load of debt out, which Spoons has, you should probably do something to guard yourself against getting whacked over the head by an interest rate rise. See everybody with a mortgage from 2 years ago. But Spoons did do this. They've now sold those swaps for 169 million. And that turned out, that's more than their total free cash flow. In fairness to them, there's also a bunch of other one-off things going on as well, like a bunch of one-off investments in pubs and a bunch of one-off freehold reversions and those sorts of things. So there's quite a lot of one-off costing things going on in there. Point is, that's not a particularly representative free cash flow number. What is representative is inflation pressures. They are crushing margins, and Spoons runs low margins anyway. It runs low price to customers. That's its kind of basic model. I'm never quite sure what to think with the idea that Spoons has not been increasing prices. You can see this one of two ways, I think. You could either see it as they can't. Their job is to have lower prices than everybody else. If you start raising the prices, that takes away your kind of USP. So it's bad. So you have no pricing power at all. So your margins are just going to get ruined for the foreseeable. Alternatively, that's the kind of bearish way of looking at a lack of a price increase. The, I guess, more bullish, more positive way is saying they won't. They can but won't. They are already way lower than everybody else. They could raise prices and still be the lowest in town, in pretty much everywhere that they operate. But they choose not to, and that keeps people coming through the door, and that means they can raise them a bit later if it comes to it. So they are just basically building out their, call it brand, call it moat, call it USP, call it identity, any of those customer base, any of those sorts of things, more or less. Get them in first, try and heat them up later. Sort of in the style of Netflix, but with a wildly different business model. Steve, this has gone, I mentioned this a couple of weeks ago, and the stock has gone up and up and up since then. I didn't particularly call it for that reason. I wasn't thinking I'm aiming at this particular earnings thing. Do you have any thoughts on any of these?
They were okay results, I thought. I mean, they're below the inflation rate, but then that's kind of the business model, isn't it? He's not trying to pass the cost of inflation onto customers. He's just trying to be the cheapest pub in town, and they do a very good job of that. I did see in the earnings comments that he took a swipe at Brexit, and he took a little bit of time out to praise the current government on a few things, which is always interesting because, like I say, he acts like he's the drunk guy in the pub. But yeah, the only things that really sort of jumped out to me was that most of this sales increase was on the fact that they charged a little bit more for food, and they got some decent revenue out of their slot machines this time round, which is it's always a kind of sad thing that I think that when that amount is growing. But I think you pretty much called this one, Steve. I think this is what you... Well, I listened to the episode back last night just to see what you did say, and I think the vast majority of this was even more so than what you expected.
It's an interesting one. I think it's probably still got a way to go when I look at this. I still think it's kind of cheap, and I'm now really stuck. I didn't buy it before. I saw it at about $5.50-ish and thought, would like it at a $5 for no real reason other than I'd previously seen it at a $5. Basically did everything wrong when it comes to this, right? Thought about some bunch of good reasons why this stock is currently undervalued. Or at least a bunch of reasons I thought were good and about why this stock is currently undervalued, and then decided I'm not going to buy it because it's not more undervalued than it once was, which is exactly the wrong way to go about things. I don't deserve to buy this thing. I think it's got further to go from here when I look at where I think its cash flows might end up. Debt's coming down, which is encouraging, and that's the thing that really worries, I think, basically everybody. I suspect the people who read the debt line off quickly, and I am one of them on this, weren't factoring in potential gains from interest rate swaps. I looked at that and thought, that's a lot. How are we going to get out from under this? I didn't think about that particular line of protection when I was talking about it before. I suspect all the people who are kind of doubtful on it because it's got way too much debt haven't thought of it either, so I don't think it's just me. But I'm still reasonably encouraged by this. I know some people who do own these shares, and good for them. To be honest, I'm pleased it's doing well.
So not a buy today, or do you think you could be tempted?
Feel like I ought to. Feel like there's a lot that I'm kind of tempted by at the moment. I'm really struggling to look at anything that isn't a bank right now. I'm not looking at many banks, but there are a few where I sort of think the strong are getting stronger here, and there's risk-reward wise, they become kind of attractive. I was looking at that Swedish bank again, actually, which is Svenska Handelsbanken, based in Sweden with a branch in Hull on the main road in East Hull or whatever it is. But I've still got work to do there.